Why the wealthy don't keep money in banks. Introduction: The misconception of bank safety. Many people believe that keeping money in a traditional bank account is the safest and most responsible financial decision. However, this perception is largely misguided. Banks are not the optimal place for growing wealth. In fact, placing large sums of money in a bank account can result in substantial financial loss over time due to inflation and opportunity cost. Where wealthy individuals store their money. Wealthy individuals do not typically keep their funds in low-yield bank accounts. Instead, they strategically allocate their capital into money market accounts, U.S. Treasury securities, real estate, and equity investments. For example, Elon Musk owns a significant share of Tesla stock, Jeff Bezos retains a stake in Amazon, and the founder of Nvidia maintains ownership in the company. These assets not only appreciate over time but often pay dividends as well, which further increases the investor's wealth. The mechanics of bank lending. Banks benefit immensely from holding your deposits. With a system known as fractional reserve lending, they can lend out up to 10 times the amount of your deposit. For instance, if you deposit $100,000, the bank may lend out $1 million, charging interest on that amount. Despite this enormous profit margin, banks do not compensate depositors accordingly. Your $100,000 sits idle while the bank profits, and you earn negligible interest in return. The impact of inflation on savings. Inflation erodes the purchasing power of money over time. The Federal Reserve targets an annual inflation rate of 2 to 3%, meaning your savings lose value each year they remain uninvested. If you earn less than the inflation rate in interest, your money is effectively shrinking. For example, with a 3% inflation rate, $100,000 loses $3,000 in value each year, even if the number remains the same in your account. The concept of active money. Wealthy individuals treat their money like employees. Every dollar must work. Bank accounts are considered dead money because they generate little or no return. Instead, successful investors move money into appreciating assets or income-producing investments. For instance, money market accounts yielding 4% or real estate investments generating 6% returns, especially when leveraged, create passive income and build wealth. The power of leverage, acting like a bank. Banks use leverage to generate returns on your deposits. You can do the same? By placing 10 to 30% down on a rental property, you can use financing to control an asset that appreciates and generates rental income. This strategy allows individuals to build equity while earning income, effectively becoming their own bank. The illusion of security in banks. Banks spend millions on buildings and branding to project safety and reliability. However, FDIC insurance only covers up to $250,000 and may not offer immediate liquidity in a financial crisis. History shows that banks can and do fail. Placing blind trust in these institutions without understanding how your money is used is risky. The real cost of saving. Consider the long-term impact of storing money in a bank. A 3% annual inflation rate over 3 years equates to a nearly 10% loss in purchasing power. If you begin with $100,000, you effectively have only $90,000 in real value after 3 years. This hidden cost accumulates over time and is rarely accounted for by the average saver. Transforming your financial mindset. It's time to treat yourself like a financial institution. Rather than depositing your money for others to use it to acquire assets and generate income. Real estate, business ventures, and other investment opportunities allow you to use leverage and compounding to your advantage. Be the bank, not the depositor. Final thoughts: empowering financial literacy. Financial empowerment comes through education and action. You do not need to rely on financial advisors or money managers. especially if they have not demonstrated financial success themselves. Today, knowledge is easily accessible. Leverage tools, mentors, and digital resources to take control of your finances. Let every dollar you earn work for you and protect yourself from the hidden cost of financial stagnation.